Okay, everybody, here we are. Number 20, the grand finale of our 20 consecutive master classes, estate planning in 20 days here in the year 2020. So I'm kind of disappointed that it's winding down. And I'm maybe even a little more than kind of disappointed. Just to kind of share a few quick thoughts before we jump into the topic. I didn't know what I was getting into when I did this, but it has evolved into something that it's really kind of changed me. So I scheduled these things. I started presenting them. We had some really good, and I've always had really great participation. And then in this crazy environment that we're in, I guess about 10 days into it, one of my children was diagnosed or tested positive. She's okay. She's 19. She's like all those other youngsters who are out there testing positive. Had some symptoms for 2 or 3 days. Feels much better now. But nonetheless, it required my wife and I and our daughter to self-quarantine here. So, we've had no interaction with anybody. Nobody over for Father's Day. Nobody comes in the house. We don't go anywhere. We don't see anybody. So really, this has been my, people interaction for the last, over a week. And it's kind of been the highlight of my day, as sad as it may sound. But, I get up every morning excited that I have this to do. And so I've gotten a lot of enjoyment out of it. And so I'm going to move on to bigger and better things. Not exactly sure what I'm going to do, but it will likely involve YouTube, and it will it will involve educating. Be happy to hear your feedback and that kind of thing on what you'd like to hear or see or learn, and I'll take all that into consideration as we move forward. So, wanted to wrap up and really talk about some of the mistakes that are made as people get into estate planning. By the way, good. Okay, thanks, Slim. Slim Dog, by the way. Thank you. Just as part of my routine, answering a few questions. I think I had maybe 1 or 2 questions come across the old YouTube channel comments in the last 24 hours. Let me get to them real quick. Comments. Okay. I've had this come up, and this is appropriate in the kind of environment that we're in with the government, giving money to everybody. So this is a question that has come up several times in the last few weeks. Has to do with a person in a nursing home on Medicaid and getting a stimulus check or whatever you want to call it. Herbert asked 14 hours ago, how can a person under Medicaid spend the money she has if the account balance goes over $2,000 after the stimulus? The balance is above $2,000. The nursing home is worried she will lose her Medicaid if they see the balance above $2,000, even though it is still close to $2,000. Really good question, Herbert. Been getting that a lot. And really my best answer is just a guess. But I realized, even before people in nursing homes started getting stimulus checks, and quite frankly, people in nursing homes on Medicaid, they don't want stimulus checks. That Medicaid is very valuable, and if a stimulus check could cause them to lose their Medicaid eligibility, it's just kind of mass chaos for everybody. But nonetheless, they got their stimulus checks. In fact, I remember lots of stories about how dead people were getting stimulus checks, or quite frankly, deposits into their account. And it's caused them to have countable resources in excess of this magical number of $2,000. And so even before, at least in my state, and I got to feel like it's the same everywhere, when someone received some money, whether it was $1,000 or $5,000 or whatever, it could have been an inheritance, or could have come from any source. Maybe the sale of an old beat up vehicle or something, and it caused someone to have over $2,000. And there's no rule that says this, but I know that what they were always permitted to do was just once they got it, then they kind of immediately turned around and spent it on themselves. They didn't give it away. They didn't create this uncompensated transfer, but they bought something, a piece of furniture, some clothing, some diapers, something that they could use for themselves to quickly, get it back down under $2,000. And I got to think that's the case here with the stimulus checks. I don't think Medicaid wants to kick anybody off of Medicaid because they got a stimulus check. And this is just me common sense thinking, but again, haven't seen any regulation on it. I would think that it would be appropriate for that person just to go spend that money on something for themselves and get it back down under $2,000. That's my best guess there. That's a good question, Herbert. Perhaps an inquiry to the Medicaid office or a phone call may be appropriate there, or maybe it won't be, for some obvious reasons that sometimes you don't want to raise the red flag, as they say. All right, so that's it for that. Keep bringing on the live chat. If you got questions, this is it for the live chat. So number 20 of 20 here. So bring them on. I love the live chat. It's the reason I do it live. I want people to be able to get their questions answered. And I think we'll be answering a lot of questions and talking about a lot of stuff that you may have on your mind as we go through on the picture it said 5 deadly mistakes, kind of no pun intended, or maybe pun intended, but really 5 common but costly estate planning mistakes. All right. Let's get right into that. I put number 1 first because you got to avoid this mistake early in the game as one of the biggest mistakes. And mistake number 1 is working with the wrong person, company, advisor. It's just not getting guidance from the right source. Let me give you some examples. And I put that as number 1 because once you get started going down the wrong path, it's often difficult to undo. Sometimes you may start something or do something that quite frankly can't be undone. Or you may incur an expense and then now you realize you made a mistake and now you have to incur another expense and kind of start all over again. So you want to work with the right, I'm just going to say people, but by people I could mean person, entity, business, law firm, corporation, whatever. You want to make sure you start out working with the right people. I'm going to give you some generalities here. I'll just jump right in. So when I say, a financial advisor, you work with a financial advisor, you work with a financial person. I'm being very general here. There are a lot of people in the financial services field that know their stuff. They do a good job. Heck, I just realized there's a financial advisor that I know very well. It's his birthday. I just texted him happy birthday. He texted me back. He wanted to know if I'd seen some things on a website. So anyway, a lot of good ones out there. But in general, and when you rely on the financial person, and that could be the stockbroker, it could be the insurance agent, it could be the certified financial planner. When you rely on that financial person, you're going to get some answers that may not be in the big picture best interest. So, for example, talking to the financial person, and you say, you know what, I need to do some estate planning. Often their response, generally speaking here, is, oh, estate planning, you need to buy a life insurance policy. Or maybe you talk to the financial person, I'd like to kind of inquire about whether I need to avoid probate for my heirs. The response, need to avoid probate? Great, let's put you in an annuity because you name beneficiaries that avoids probate. Or maybe you even initiate the trust conversation with the financial advisor. And then the response is always going to be, well, I'm not an attorney, but, and then they kind of give you their 2 cents worth on whatever. That's kind of same thing with a CPA. Go to the CPA and start talking estate planning. They're going to say, I'm not an attorney, but, and oftentimes, they don't really see the big picture. They're not really good listeners. So, and then even you could be working with an attorney and it could very easily be the wrong attorney that you're working with. Things I hear, Paul, that attorney talked over my head. I didn't understand what they were talking about. Paul, the attorney talked too much. I mentioned I was able to get a couple of words in, they would tell me, about what I was trying to accomplish. But other than that, they just kept, kind of ramming this stuff down my throat. So there's attorneys are not the end all cure all for estate planning. So, and then there's the whole legal document software. So we did one of our YouTube presentations on should you use the LegalZooms of the world. And my concern there is you don't know what you don't know. And so you have no one who's able to say, well, I know you answered this question online this way, but based on what you told me 5 minutes ago, let me kind of inquire about that to see if we're still on the right track. You just don't get that with the legal document software stuff. So really, you need to start off on the right foot, work with somebody. I would say most important criteria are they need from the get-go to help you uncover what it is that you want to most accomplish. Many people in my conversations will tell me, Paul, the most important thing to me, and when I hear those words, I better have my pen in my hand and jot down exactly what they say, because if they preface a statement with what's most important to me is, then I'm going to make sure that that gets accomplished. So you need to work with somebody who can pull what's most important to you out of you, is a good listener, and then focuses on helping you accomplish what you're trying to accomplish. And in many cases, in order for them to help you accomplish what you're trying to accomplish, you need to work with somebody who has a really excellent working knowledge of, tax law, as we'll get into in a minute, not just the estate and gift tax, the capital gains tax, the income tax, the property tax. You need to work with someone who has an excellent working knowledge of your particular state's trust code, of kind of inheritance law, and then helps you, create an overall program that accomplishes whatever it is that's most important to you and your family. And yes, you'll typically need to work with a lawyer to get that done, because often that comprehensive program, or maybe always that comprehensive program, includes the preparation of a number of these legal instruments that are necessary to get you where you need to be. So I want to emphasize on this reason number one, and the reason I made it number one is because if you start by taking the advice of the financial, you may invest or purchase in some instrument that you're not able to get out of, and then after you finally get a chance to uncover the big picture and realize that maybe you should not have done that first, or maybe you should not have done that at all. So that's why we want to make sure the who is going to help me through this is really important. So do your homework, talk to people. If you don't have a comfort level, like, wow, I think I found the person that can help me structure this overall thing, and because this thing is going to affect generations into the future, you want to make sure you get it right. Enough there with number one. All right. Number two mistake that people make. And these mistakes are not mistakes that everybody makes, but they're common mistakes, and some people make them. So number two is the old failure to address the possibility of needing long-term care, skilled long-term care in the future. Not a real popular topic that people like to talk about, because they don't like to think about the possibility of getting sick, being in a facility. That is just not fun to many. It's not fun to me. However, it's got to be something that gets addressed, and you need to have a plan for it. And your plan might be, I'm going to take my chances. And at least it's an educated plan. It's a thought through plan. I'm going to take my chances, meaning I'm not going to purchase any financial instruments. I'm not going to try to move assets out of my name because of my circumstances and because of what I own and because of what I've saved. Me and my family will deal with it if it happens. And that can be an educated decision, and that's okay. But the bottom line is I have to include it as one of the concerns and one of the mistakes, because I just looked up a stat, and I'm not a big fan of stats because people use stats to try to ram certain actions down your throat. But quite frankly, 52% of people who turn 65 now are going to need some long-term care services in the future. Now, maybe they'll need them for 6 months, maybe they'll need them for 6 years. We don't know. But you need to be, since more than half of the people turning 65 will need long-term care, it's something that families should have conversations about. Seniors ought to be educating themselves about what their options are. And if you're going to work with an estate planning attorney, first in your long-term care options. Of course, if you first start exploring how to plan for your future needs with a kind of financial person, not a knock on the financial services industry, not a knock on all the financial advisors out there, but the reality of it, and sometimes it all comes down to money. The financial professionals get compensated from insurance companies who they represent and selling certain financial products to you. Not a knock on that industry at all. But when you talk to the financial person about, and you initiate I just want to make sure I'm protected if I or we need long-term care in the future, the very first words out of their mouth are, you're gonna need some kind of long-term care insurance protection. And so it will go from the traditional long-term care insurance, not as popular anymore. Now it's the life insurance and annuity with the long-term care riders. You're just going to go down that path, and that's going to be the end all for the conversation about perhaps you might need long-term care in the future. So really, you could wind up making decisions of 1 or 3 or 4 ways. You could take advantage of some of the financial offerings that are made, ones that I just mentioned. You could take advantage of legal strategies in order to qualify for Medicaid eligibility. Many middle-class people do that. You could make a decision that you'll just kind of self-insure, and you're happy to self-insure because you want to keep what you have, you want to keep it in your name, and maybe you have some family influence who has you convinced that they'll never put you in a facility anyway, that they're going to take care of you, whatever the case may be, whatever that positive family influence might be. So, but you need to have the conversations with the family. You need to understand the options. You need to make an educated decision, whatever that decision might be. All right, so that's number 2. Number 3, let's move right into it. Bridget, good to hear from you. I know you're a somewhat familiar presence on the live chat, on the YouTube videos. Have a good day. I like your little mouse there. Okay. All right. And then number 3 is especially in my state, the failure to even address probate, or as we call it in Louisiana, succession. And I know in many states it's just no-brainer. Everybody does whatever they got to do to avoid probate, because probate is an absolute nightmare. And so, but probate can be difficult and is often difficult. Not every time. Probate's not a complete disaster nightmare in every circumstance, but at least address it. And again, I'm just asking you to make an educated decision. And if you understand what the options are, which essentially are, I can kind of keep assets in my name. I'll use perhaps my last will and testament to provide for the disposition of those. And yes, when I die, my survivors will need a lawyer, and they'll go through a court and attorney involved process to get things transferred. And that's the decision that I make. I'm comfortable with it. That's good. And that's okay. And then there's others who will say, no, I'd like to set things up in advance so my family doesn't have to go through that. I want them to avoid the court and attorney involvement. But many people, they work with someone and they don't even get the opportunity to make an educated decision. So really important that you make the educated decision. Have had many conversations with people who have said, you know what, Paul, we went 7 years ago to a lawyer because we knew we needed to get our legal affairs in order. And so we did a will, and the lawyer didn't even bring up the fact that we could avoid, having to go through the courts when we die. Why didn't they do that? And, Don't ask me why they didn't do it. Ask them why they didn't do it. I have an idea why they didn't do it, but but at least, make an informed decision. And if you choose the route, if you make the informed decision and choose the route of using your last will and testament, acknowledging that your survivors will go through a succession or probate, at least once you've made that decision, structure what you have so that the likelihood of that probate being difficult, the disaster, whatever you want to call it, the likelihood of that is minimized. And you'll do that by selecting the right executor who will hire the lawyers and guide the family through the court process. Don't just select the executor because you wanted to appoint this person because you didn't give them any other jobs. Have conversations with your survivors about how you expect them to handle things, to act as they go through the court process. Organize all of your asset information, any debt information, all those things that will have to play a role in your, estate settlement process. Organize that so your survivors aren't left with having to do this fishing expedition of what did he or she own, and then they go through the lawyers and go through the court process, and then 6 months after that's done, they discover there's other assets that they didn't know about. So now you're back to the lawyers, reopening the probate, and just a mess there. So if your survivors are going to have to go through that, make it as easy as you can for them. It's kind of the last act that you've made for them. It's kind of maybe even how you'll be remembered. So do what you can to make it easy. And then, of course, if you make that decision to attempt to avoid all the probate stuff, then you'll want to go back and look at the videos and all that about how to do it right, what decisions you make, who are going to be those trustees of your trust when you die, who are going to be the beneficiaries. Are things titled in a way that they need to be titled so that nothing's frozen when you die, and your designees have access to everything and can immediately do what they need to do, whether it's sell trust assets or disperse them to beneficiaries with little or no court or attorney involvement. So that number 3 is the addressing probate piece. Really, really important. Make informed decisions. And so you're starting to see a pattern here in these mistakes. All underlying all of these mistakes is get yourself educated. Work with the right people who can objectively listen and guide you through it. Have conversations to the extent you're comfortable having the conversations with your survivors, with those people that you're putting in charge of different things, so everyone knows what your expectations are, and it may drive them to act in a way that avoids conflict and disruption if you've had conversations with them and told them what your expectations are. All right, number 4 most common mistake, but costly, is, and I'm going to have to explain it for just a minute, but it's making sure you cover reasonable contingencies, probably an emphasis on reasonable. But what I'm not referring to is, Paul, I want to leave my estate to my children equally. They're all adults, they're all healthy, but if all 3 of my children die before me, I want it to go to my grandchildren, but not this grandchild, because if my grandchildren get divorced or get on drugs, or if they die, I want it to go back to this charity if all of my children and all of my grandchildren are dead. And then if that charity's not around, I want it to go to this church. And by that time, we're getting into too many contingencies. I'm like, look, let's cover the reasonable ones. And if there's some major change in your family circumstance, come back and you can always revise what we've done here. But let's just cover the reasonable contingencies for now. We're going to get too much in the weeds to try to cover these. If this happens and that happens and that happens and that happens, then I want this to happen. That's it's too much. Now, but the things that are reasonable contingencies that need to be addressed are, and again, this is just needs to be communicated, and then you make an educated decision. So things like, what if I die and my spouse chooses to remarry? What's going to happen to my estate when my spouse remarries? And maybe your educated decision is your spouse can have it, and there's my children. So if my spouse remarries, I know that my heirs are protected. Maybe you need to cover the contingency. What if I die and leave things for my spouse, and my spouse starts to lose cognitive ability and runs the risk of being, influenced by some predator or by some son-in-law or some other third party? What can I do to protect myself, my heirs from that situation, which happens often? What if I pass away and leave things to my kids? If I leave things to my kids, looks like we're okay. If I leave things to my kids and they subsequently get divorced, I'd like to leave it to them in a way where their ex-spouse doesn't get to enjoy half of what I leave to my child. So those are a few of the reasonable contingencies. And then kind of in the same ballpark there is the whole non-probate asset beneficiary designation. So you see a lot of people, they have their IRA as their largest financial asset. They name their spouse as their primary beneficiary. And maybe they do that with their 401k when they're 30 years old, and now it's 20 years later, it's 30 years later. And their spouse, maybe they're divorced, maybe they predeceased. And we're seeing often a lot of retirement accounts, traditional IRAs, Roth IRAs, 401ks, 403bs, and also life insurance and annuities. We're seeing a lot of kind of by default, those assets being payable to the estate because either no primary or no secondary beneficiaries were designated. And we really don't want retirement account assets being payable to an estate. It triggers adverse income tax consequences. And so really important there to, make sure you cover those reasonable contingencies. That's number 4 of our 5. Good morning to you, David W. Nice to have you. D-Dub is what I'll call you, David W. So D-Dub, good morning. Nice to have you on the chat today. All right. And my 5th and final common mistake that gets overlooked in estate planning, don't disregard it right when I say it, for reasons I'll tell you about 15 or 20 seconds later, is the whole disregard for taxes. And the quick note on that is I'm not talking about just the estate and gift tax that most people won't have to deal with, because we have this $11.58 million estate tax exemption. I'm not talking about that. Yeah, the wealthy people and maybe 1 out of 500 out there watching this live or watching a recording will actually have an estate tax burden under our present estate tax structure. But I'm not really talking, when I say taxes, I'm not really talking about the estate and gift tax. That's usually the first words out of the individual's mouth or the financial advisor's mouth of when taxes are brought up in an estate planning concept. We don't have to worry about that. I wish we had that problem. It's a nice problem to have. We'll never have that much. I'll call you back when I win the lottery, blah, 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 blah. That's the whole estate tax related to estate planning. Other income tax, capital gain tax, that affects everybody with taxes here in a minute. But we do got some live chat, so I got to get right to it. D-Dub says, we only have one child. Can he be the executor, the trustee, and beneficiary? Yes, no prohibition on him being all of that. You can leave everything to that child. You can set up a trust, and that child is the beneficiary. He's the trustee when you and your spouse pass away. He's the executor of your will or your pour-over will or your conventional will. So he can fill all of those roles. You don't have to get any other person involved. He'll probably also be the what's called the agent on you and your wife's powers of attorney. You'll name each other first, name your child as the alternate agent on your powers of attorney. So all of those roles he can and should fill. Many parents with one adult child have no reason to get anybody else involved in administration of the estate, both during your lifetime or when you pass away. Does per stirpes bypass your child's spouse? Yes. So it generally means I leave my estate, I name as my beneficiary, whatever you want to call it. I leave it to my child or my children per stirpes. What that means is if a child predeceases, then when you die, the predeceased child's share will go to the predeceased child's children. And so does it bypass your child's spouse? Well, if all of that happens and it goes to your child's children, and if those grandchildren who are now inheriting, if they are minors, then your deceased child's spouse, who may very well be the parent of those grandchildren, will likely control the grandchildren's inheritance until the grandchildren reach the age of majority. So if you even want to eliminate that possibility, then you probably need to designate that things will go in a trust for the grandchildren, then you designate some other trust. Keep them coming, D-Dub. One more question. If we put our home in a trust 6 years ago and sell it today and buy a new home, does the fund? Okay, so if you put any asset in one of these irrevocable trusts, a very good question, we get it often. You put your house in a trust. You put your, if you have rental property, you put in a trust. You put investments, publicly traded stock in a trust. But we're going to stick to your question, D-Dub. 6 years after you put your house in a trust, you decide, you know what, it's time to sell and I want to buy a new home. So 6 years after you put that house in your trust, then it's sold inside of the trust. The check at the closing is payable to the trust. That check is deposited into a trust account that either already exists or you create at that moment. And then you use those funds and have the trust purchase a new home inside of the trust. So no, that doesn't trigger any new 5-year period. What triggered the assets into the trust, but the selling of trust assets and the buying of trust assets inside the trust, that's not an uncompensated transfer. That doesn't create any new 5-year penalty period. Now, what some people do is they just kind of forget, and then they put the money in their bank account, and then they buy the new house in their name, and then they've got to put that in their trust. Just make sure you do it as I mentioned a moment ago, and which is really the way you have to do it if you just kind of follow the money trail. All right, good question there, D-Dub. Bridget, what about a biological child that was adopted out before mother married my father, not a half-brother? He was legally adopted by my grandparents and inherited from them. Man, when I'm on these YouTube live presentations, I'm kind of ramped up, and so it's hard for me to concentrate on those questions. Let me give it a shot. Biological child adopted out before mother married my father. So mother had a child, gave it up for adoption. Mother married father, not a half-brother. He was legally adopted by my grandparents and inherited from them at my expense loss. All right, so it's a state law issue. So I'm going to say in our state, not necessarily the rule in your state, Bridget. Would love to hear where you live. But if a mother has a biological child that she gives up for adoption, and if mother, and let's say, mother dies years later, if mother doesn't have a will, then that child inherits. And so the child gets to inherit from the mother and the adoptive parents. Now, mother could, has the ability to leave assets to whoever he or she wants to. So that if nobody has a will scenario, don't think you're locked into that. So anyway, just a quick answer to your question, Bridget. And I don't know the whole backstory, but looks like some things happened, and as you say, at your expense or at your loss. So I wish you well there. M. Shrestha, great name there. Does a trust need to be amended if we move to another state, even if the assets are the same? Not necessarily. Good question. So many people will form a trust while they live in a state. They ultimately decide to move out of that state. They move, they live in another state. Gave this advice maybe yesterday or the day before. That doesn't necessarily mean that things need to be changed. You need to set up any kind of new trust because you moved to another state. But moving to one of those states is one of those family circumstances where it's probably a good idea to get in touch with somebody like me who lives in that new state, show them what you have, talk to them about what your objectives are, and just make sure that no amendments are necessary based on some particular or peculiar state law that may exist either in the old state or in the new state. So maybe nothing needs to be changed. I can certainly tell you that if you have a trust in one state and move to another state, just the moving doesn't invalidate that trust that you originally created. That's not the case. But, different states have different rules, and based on what your objectives are, things should be reviewed. It's simple enough to get them reviewed and get some advice on whether things are good like they are, whether some amendment may be necessary to accomplish what you're trying to accomplish, or maybe even more than that. So get that checked out. You're welcome, D-Dub. Great question. Yes, I agree. All those questions are great questions. I got to tell you, the live chat, the questions in the live chat, I thought moving into day 20, I was like, well, I hope somebody's watching. And if somebody's watching, and if they throw stuff into the live chat, I hope it's just not a bunch of garbage being thrown and negative Nellies and all that in the live chat. Amazing contributions in the live chat that have really taken these things to another level. So great job, everybody, in that. All right. So I got to go back to what many is kind of a dry topic, but it's an important one on my fifth common mistake. But thanks for the series. You did a regular trust for me and all the help feel comfortable. Fantastic. Good to hear that. Great to hear from you there. Dugan, I guess, is the way I pronounce it. Okay, so I did want to get back to number 5 because it's often overlooked. It's a common mistake, the whole tax stuff with estate planning. And yes, like I mentioned ago, 1 out of 500 of you or something like that will have estate tax consequences, but for the 499 who don't, and I gotta tell you, our estate tax, it's going to affect more people in the future unless they change it, because this $11 million exemption that we have, it's just gonna fall off of the books on January 1st of 2026. Most of the people listening to this YouTube live presentation are gonna still be around in 2026. That's just 5.5 short years from now. So the estate tax exemption will be cut in half if there's no, congressional action. So that means that people, even with and I know this is a lot of money, but people with a $3 or $4 million estate may need to be preparing now for that estate tax exemption that will be roughly $5 million adjusted for inflation. I'm going to call it $6 million in 2026. So particularly if the first spouse dies, I did a video in the past on what's called the Portability Election. So when a married person dies, a surviving spouse, even though they're not required, they may want and may be able to benefit their family by filing an estate tax return, making these elections to really increase the amount of the estate that can be left to the heirs or children when the surviving spouse dies. Check out one of those videos if you want to know more about portability. All right, and then I'm going to go into the whole income tax, and I got something to say about kind of how the government this year has arranged for income tax to be paid and this kind of bonus that they're giving people this year and how it's coming back to bite people. I'm going to talk about that in just a second, and it really it kind of irritates me a little bit. I'll get to that in a minute. Slim Dog with a third-party special needs trust accumulation. Is it still possible to stretch distributions over the beneficiary's lifetime, assume they qualify under Secure Act as having disability? Yes, that would be perhaps be a conduit trust. And I've done stuff on accumulation trust and conduit trust. Well, either one is one of the exceptions under the Secure Act, which ordinarily requires people to non-spouses to take beneficiaries and take out all that money and pay the income tax within 10 years from the date that the IRA owner dies. There's some exceptions if And again, being disabled is one of them, where the disabled person can use their life expectancy, and they don't have to take it all out within 10 years. They can use their life expectancy and take distributions over their lifetime. So yes, if it's a see-through trust, then you look through the trust, and I've done some other videos on that, to look at the beneficiary, who is that disabled person. And yes, distributions will be able to be taken over that disabled person's life expectancy. So that's just another really good example of a fantastic question that we're getting in the live chat. Just really, really good. Okay, so going back to how the income tax and capital gains tax consequences are overlooked, let me get into that, and let me give you my kind of beef here. There's a lot of income tax consequences to estate planning. The general rule is, yes, if you leave a bank account, if you leave a home, if you leave shares of stock to an individual as an inheritance, in general, an inheritance is free of income tax. But that doesn't mean estate planning doesn't have income tax consequences. A lot of people out there, their largest financial asset is their traditional IRA or their 401k with their employer. And so there's income taxes, just as Slim just asked about, and I responded about the whole name individuals. If they're dated, can name a trust as a beneficiary. If so, how does that affect the income tax distributions? Pausing here, looks like we had an unstable connection, so I'm back. And so all new rules with the Secure Act. It used to be all non-spouse beneficiaries could take distributions over their life expectancy. No more. We have this 10-year requirement. That's a piece of it. The capital gains tax consequences. I'd say 99% of married couples who go through this estate planning exercise, the whole concept of a double step up in basis doesn't even get suggested to them. They don't know about it. The advisors don't know about it. But again, it's one of those educated decisions that has to be made, because if the first spouse to die, whose assets get a step up in basis, which means appreciation goes untaxed ever. If the first spouse to die leaves assets a certain way for the surviving spouse, then that doesn't happen all the time. The first spouse to die often, especially under our old estate tax system, the first spouse to die never wanted the first spouse to die's assets to be lumped into the estate of the surviving spouse, because they didn't want the first spouse to die's assets to be included in the surviving spouse's estate for estate tax purposes. Now with an estate tax that doesn't affect as many people, we want the first spouse to die's assets to be included or lumped into the estate of the surviving spouse, so that all of those assets get another step up in basis for estate tax purposes when the surviving spouse dies. I know that's a mouthful. You may need to watch it again. You may need to go back and look at other videos, but double step up in basis, probably something worth looking into if you're a married couple and you have assets that have appreciated and you would like your future survivors to not have to pay any tax when they sell your family home after you die, when they sell investments that you've kept and saved over your lifetime. So, okay, and then just a kind of a non-estate planning related question, just kind of a warning out there, something I've realized a few weeks ago. With all of these bonuses that the government and the Treasury Department is giving us, taxpayers, particularly if you're a business owner, there's going to be a date on July 15th coming in a couple of weeks that's really been creeping up on people. Because under the old rules, a person, particularly a business owner, but anybody, would pay their taxes on the previous year for 2019 on April 15th of 2020. And then at that point, they'd pay their first estimated tax for 2020. And then in June, they'd pay their second estimated tax for 2020. Well, Congress has postponed all of those deadlines. So here up on July 15th, that's the deadline for taxpayers to pay the tax on their 2019 taxes. And then the Treasury Department postponed when the first two estimated tax payments are due for 2020. Instead of one being due in April and one being due in June, they pushed those back to both being due in July. And many business owners do not have the revenue in 2020 that they had in 2019, and their 2020 estimated tax payments are made based on what they made in 2019. So you got in July 15th, tax due for 2019, and the first 2020 estimated tax payments based on what was earned in 2019 2019, there's going to be a lot of business owners that are just not going to be able to make those payments on July 15th. So I'm expecting some fallout from that. I haven't seen any of that in the media, but it's probably coming. Okay, so we talked about the income tax. We talked about the capital gains tax. Maybe there's even property tax issues related to estate planning. Depends on your state, whether you're making transfers of assets, and so property tax can be an impact in what you've done here. Looking at my final notes on my Windex teleprompter here. So you might like that. So anyway, there you have it. And now it's time to really wrap up our last and final 20th of 20 YouTube presentations in 20 days in the year 2020. What I really am excited about is these presentations and the chat and all the questions and all the great contributions. There will forever be a permanent record in YouTube of all of these presentations. So they'll never go away. The participation and the has been just really kind of fantastic here. I feel like I've made some new friends, whether that's Ron or all the others who have contributed. You know, just on the screen here, we've got David, Slim Dog, Bridget, got people in Louisiana, got people in different states. We even have some people in countries, other countries besides the United States, being a participant. So where we're going to go from here, I will tell you, I'm looking forward to even bigger and better things. I haven't exactly defined what I'm going to do. If you've got some suggestions, I'll be happy to listen. You can throw them in the live chat. You can throw them as a comment to any video on my YouTube channel. But I think I have a better idea after 20 days of what kinds of things do people feel like they need some, a lift from, because just by looking at all the questions in the live chat and being able to find out what's on your mind there. My number one goal with this YouTube channel is just to educate as many people as possible, and over almost, over almost 4 years now, just we've seen the graph just kind of do this and start going up. I know that in my first year of this YouTube channel, and I hate to focus on the statistics, but I had my channel gained 7 subscribers in the first year, and now we're 3.5 years into it, and we have over 6,500 subscribers to this channel. I think in my first year, I had maybe 1,000 views of different videos that I've made, and now it's over 630,000 views of all the various videos that I made. So I'm really pumped up about that, and I know it takes a lot of work to increase that momentum. So again, I want to thank everybody for contributing. Alex, thank you for your participation. Johnny, good, I like that. The more scenarios that us normal people can relate to. But I got to tell you, Johnny, I've got something going on that makes them a little something other than normal. All right, got a from Les Lakey. I haven't seen that name before. Thanks for the presentations. Gives you lots to think about. D.N. Preston, you're a regular. Thanks so much for all your very informative videos. Great to have you on the live chat on a almost daily basis. So again, I feel like I got some new friends here. Hopefully we can keep the dialogue going in the future. This by no means is the last you've heard from me, just the beginning. I get a lot out of it. Y'all go out, take care. We'll see you down the road.